beware of gross margin in the early days. That's a mistake we made a couple of times. You have a lot of businesses that in the early days have really bad gross margin. All the LLM providers were very clear examples of that. I think if that's the only thing that's holding you up, in most cases, I would totally ignore it. We never lose a deal or pass on a deal because of price in the early stage. So we've been around for 30 years. We invested $11.5 billion. We've returned close to 30, and we still have 20 plus in holdings. Most of that is concentrated in 8-9 companies. We invested in probably 300, close to 400 companies over the years.
Ready to go? Martin, it's been 8 years since our last show. We last did it on Skype. A lot's changed, man. You still look just as young, but thank you so much for joining me, dude.
Thanks for having me.
Dude, I want to start with a statement that you said before, and you said it actually in a Kaufman Fellows event. You said, venture is about playing the right game. And I loved this statement, and I wanted to turn it back on you and say, what is the right game then for you?
I think the way I put it for this particular statement was, very much playing the long game. It was very much playing the long game. The fact that if you are to get into this industry and this job, you've got to commit for, 10, 15 years at least, and focus on not on the outside reward or not on the external, just progressing as a career. But very much more on the internal and doing it for the right reasons, which is investing in great companies, supporting great founders. That was what I really meant by that.
I think in the last cycle, we added a wave of tourist VCs who like the events, who like the idea of being a VC. Do you agree that we have this wave of tourist VCs, and has it cleared?
I don't know if I would say tourist VC, but I would say it's the asset class has institutionalized. It's become, funds have become larger. There's more people in general, by and large. And so you bring people who may sometimes want to have a career, choose it as a career more than as a calling. And I think, me personally, I think us at Index see this job as a calling.
Doug Leone said on the show that we've moved from a high margin boutique community to a low margin commoditized industry. Do you agree with that statement?
Not entirely, no. I know there is a meme which is the industry is diverging into two camps. You either have the mega funds, the asset gatherers, or you have the tiny boutique shops. And I don't truly believe in that. I think there's a third way, and Index is in that third way, where you need enough scale to help support the founders. And we think always from the founders' point of view, how can we best serve them? And you need a minimum size to really help them to kind of invest across stages, support them from inception to IPO. You need a minimum size, but I also don't think you need a giga size to really support them. I think this push towards larger asset gathering is very good for VCs who do it. It can make a lot of sense financially. It can make a lot of sense for them. I'm not sure it makes so much sense for the entrepreneurs themselves. So I do believe there's a third way.
What do you think that minimum size is then?
Exactly where we are.
How big are the latest funds?
We have a $300 million seed fund, $800 million venture fund, and $1.5 billion growth fund. That's the latest.
And that is the minimum for what you need. Perfect.
I wouldn't say that's the minimum. We see it as the right size to both support entrepreneurs with the right amount of capital, and then have enough to pay for the infrastructure that we have.
So my mind has changed on this. I thought that the mega AUM gatherers would see denigration of returns and actually would bluntly just fee accumulators. And actually now when you see the expansion of outcome sizes and more trillion-dollar companies than ever, and a very few number of people being able to write $1 billion check, I think actually they will do incredibly well investing in your OpenAIs at 300 million and your Anthropics at 60 billion and see venture-like returns at scale in a way that I really changed my mind on. Do you think I'm wrong to have changed my mind in that way?
I think I'm not sure you're going to have venture-like returns at 300 billion. I think you can have amazing returns. Can you have 50, 70x?
You could 5x $1 billion check.
Yeah, no, absolutely. No, I think the math makes sense. Do you need dedicated funds to do that, or can you do it in a more ad hoc way? I think that's a question. But I think that is on the later stage side of things. Obviously, we on the early stage, either seed or early venture or early growth. I don't think you need those mega assets, and I think they distract you and they tend to pull you towards the later stage. And if you have so much capital to deploy, obviously you will tend to focus more on the later stage, on the very big checks. And I think if you want to help and support at the earlier stage, it can be an impediment.
For the AUM gatherers, is seed simply an entry ticket to the real product, which is moving 100 to 500 million at the CED?
That is not our model, so I don't want to comment on their strategy.
That is such a cop-out. I mean, I totally think it is. I think I would admit it if I was them as well. I walk around London with my mother, and I always say the same thing, which is like, I have to give analogies. And I'm like, when you went clubbing and you have to pay the entry fee at the door, that's like seed for the AUM gatherers, and the table is the C and the D.
This is not how we see seed at all. Every check is high conviction. We don't make as many as a result, but we have high conviction checks, and we work closely with these founders even at the seed stage. It's the same as if you were a Series A. Our goal is very simple. We want to be as early as possible, become the largest shareholder, and become the most valued and most referenced investors in those companies.
I chatted to Danny before the show, and he said that Martin didn't always have this perspective on where funds would win, and this kind of third path being the middle and being your path today. What did you believe, and what caused you to change your mind?
What I've changed my mind on is if you start from the founder and if you really think through how can you best help them, what is the most helpful way that you can interact with them at the early stage, especially. How does that help them that you have 10 different products, that you do LBO, you do credit? How is that helpful to an early stage founder? It's not. And so if you really think from that first principle of, okay, what are the resources you need to be really helpful in those early stages? And again, in the service for us of building both the biggest ownership and the best reference from those founders, it's not this super large scale multi-product. It's you need enough again to support them, but you also need to be small enough to kind of keep that interpersonal relationship and that close support where they know they can call 10 people at Index and get help on anything that may happen to them. And you don't necessarily have that in such a personal and trusted way in a much larger company where people move around a lot more. A lot of our people have been around for 10 years plus, even in our strategies team. And that creates a level of trust and competency that it's really hard to replicate in much larger organizations.
It's hard when I love you, but dude, team turnover's been high. There's a lot of team turnover. Surely it's not that. You don't have much consistency in the Index team, do you? You've got Shardul, you, Jan.
Yeah, and if you look at the principal rank, we have a lot of people who've been around for a long time. If you look at the strategist rank, we have a lot of people who've been here for a long time. So there has been turnover in the industry, at large.
Interesting question. Do you think consistency of team correlates to venture returns?
I was chatting with with Ilya at Quantum Light and he about it the other day, and they said the number one factor that they noticed was a good predictor of future returns was whether a partner was on the Midas list. An early stage investor in the company was on the Midas list, which kind of tend to show that there is a persistence of returns in terms of proven investors.
Do you buy the Midas list? Again, you're like, Jesus, Harry, I thought this was an easy interview. But I look at the Midas list and none of the people on there did the deals that they said they did. I'm like, guys, come on.
Two things. One is I didn't investigate, I think, as much as you did. But my view on the Midas list is it's a really good list for who was a great investor 10 years ago. And so that's kind of how I would describe it. Because if you look at a lot of these companies, there were deals that were made 10 years ago. And so I think it's really accurate to show you, who made great investment 10 years ago. Is it very accurate to see who is a great investor today or in the future? Again, I think there is some persistence of returns, and there's a lot of studies that have shown that. But it's not, definitely there are a lot of great investors today who are not yet on the list, but will be in the future that, should be on it.
Yeah. No, I totally get you. I'm going to leave some names out. Some I look at and I'm like, really? That's interesting. We have different memories on that one. You mentioned about service and help a lot. Keith Rabois said on the show before, the best founders don't need your help as an investor. Do you think the best founders need your help?
Don't necessarily need your help. The best founders I've seen are very good at reaching out to investors and people around them on very specific topics. When these people, it's leveraging the right people at the right time, being very specific about that versus going to, I think that's a little bit a lot of the approach that we see in the market is like, it's a one-stop shop for everything. I don't think the best founders use their investor or their supporters that way.
Okay, so when we think about bluntly new deals, there's two types of founders. There's ones that come to an industry fresh and with the joys of naivety and open eyes, and then there's ones that come to it as an industry insider. How do you think about which founder type you prefer and lessons from them?
I don't prefer any of those types. The way I think about it is slightly different. What I love in founders is unique insights. And that unique insight can come, so the unique insight can come from two places. Is one, experience and knowledge of an industry. The other one is just sheer intelligence and ability to break down complex problem into very simple ones. And, if you think about all the best founders that I've worked with and you have worked with, I think that they tend to have this one similarity, which is they can come up with a very simple insight, something that sounds very simple, but actually incredibly deep and profound and defensible. And they typically come at it from first principle thinking. And I think first principle thinking gets thrown out a lot, but the very best founders, they have that. And so if you take Nick at Revolut, as an example of that, a lot of his decisions and a lot of his core insights were just linked to that first principle thinking. So he thought about, FX, for example. FX for large corridor where you have a lot of volume of transfer costs nothing. So it should be given up for free, to the market. And then once you have that, that's a really good hook, and then you can build something else. And so, and if you think about most of the great companies, they have one simple insight, but that is very deeply original. And to me, that's the core of what I look for in founders is, I want to sit there and then they will teach me something that they have come up with, either thanks to their experience but more, usually from that deep thinking that they've done and where they've solved this problem. Look at Will at Deliveroo, for example. His insight was very much the product is the delivery, which sounds obvious, but it's not the digital experience. It's the speed and quality of the delivery. And if it has to come below 20 minutes, if you can get that consistently, that is the product. Everything else is a distraction. That's the core product, and that's what we should entirely focus on.
It's funny, I had Misha, the founder of Fiverr, on the show recently, and he said a fascinating thing, which is the most important thing that's changed is time to copy, how long it takes for someone else to copy your product. When you see a dramatically reduced time to copy, does the value of unique insight go down? You could have a great idea, but I see it, and bluntly, with tools that we have available, I can copy it super fast, and I'm better at branding and marketing than you, so I'm going to crush you. Does the value of unique insight go down?
I think it goes down without great execution that comes with it. I think that on its own is not enough. I still think it gives you an advantage, but then I agree. I think it's all about execution.
Can I ask, when you think about market timing risk, it's something where I've got burnt before. How willing are you to take market timing risk when you think about unique insights?
What do you mean by market timing?
Hey, I believe this. I don't know how long it's going to take for the market to see what I believe. Versus, hey, I have a product that's super fucking great right now and it's going to fly off the shelf.
That's a very common way of making mistakes and
so you could look at Cowboy and say hey, actually, in a world today, everyone appreciates the importance of innovation on transportation, the benefits of cycling in cities.
Yeah,
it was very different 5 or 6 years ago.
So I think, look, market timing is a real thing. You can be right, but it can be that. Again, if you look at food delivery, it's interesting. People try to do Deliveroo 5 or 6 years. There was a French company, I forgot the name. It was doing Deliveroo, but what they didn't have smartphone penetration. So they had to call people. They had to call drivers to tell them where to go and where to deliver. And obviously that didn't scale. And there was no efficiency, and they would take 50 minutes. It would be very expensive. And so you needed to have not only the invention of the smartphone, but you need to have everyone, including drivers, having smartphones for something like Deliveroo to exist. So clearly here it's a true, the concept was there, but the technology just didn't follow. I think in the case of Cowboy and micromobility in general, I think the timing was absolutely correct. The challenge here in this industry is that it's if you are selling the hardware, it's mostly a hardware product, and hardware is really hard if you don't sell software on top, because you rely on a very complex supply chain which has suffered a lot over the past years. Obviously, it's a volume game. You need to have distribution, you need to have relationships. So you need to raise a lot of money to build all of those assets, and the return on that capital is not as good as on pure software businesses. If you're selling a service, so Lime and Bird and those, then I think you can have a large scale, but it is so operationally complex, and you're also competing with a lot of subsidized transportation. So you're charging full price for a service that is offered at a discount by a lot of municipal services. And you're fighting against a lot of regulation, a lot of challenges. I still think that some companies will do well actually in that space. I think Lime is doing well. I think Dot is doing pretty well. So I think they will be okay at the end. But it's clearly it's been a really, really difficult space.
Dude, I had the CEO of Lime on, and he said that at one point they had a 33% break rate every month. 1 in 3 break every month, destroyed. I mean, a hard fucking business. We mentioned Cowboy. It's a hard deal, being direct.
Yeah.
How do you prevent hard deals or losses impact future decision making? So many deals. I've met so many great fintech investors who never did Stripe because they're like, I thought it would be commoditized. I thought it was a race to the bottom. They let the past dictate the future. Yeah. How do you not do that?
Yeah, that's probably the hardest one. And actually, it's funny. It's not only the bad investments or the mediocre investment. Any investment gives you some form of bias. If it's a great investment, then everything else may look not so great in comparison. And I've suffered certainly from that. On the fintech side, for example, where I was lucky enough to be early in Revolut, and then I looked at a lot of other fintech investments. Were like, well, Revolut can do this, or Revolut does it better, or So I think it goes both ways.
And you've missed out because of that.
Yeah, exactly. And I think
what did you miss out on because you thought Revolut was great?
We could have invested in any, in a lot of other neobanks. You think Conto would be a really good example of that. A lot of remittance and certain corridors, and so there's a lot of
players. In the nicest way,
that.
Do you actually regret? I didn't mean this horribly or to single out any players. I'm not a dick journalist, but it's just like, I just think so much that value accrues to the number one.
Yeah.
In most markets. And I get it, but you're in the number one. Who gives a fuck? I didn't mean it that bluntly, but it's so demonstrably different in terms of value accretion.
Yeah. Yeah, I mean that's our that's absolutely our position. There are still some really good companies that we could have invested in. I would say so. Going back to your original question, this idea of keeping a beginner's mindset is absolutely essential for any investor. It's really hard to do. I mean, the example we always use at Index is Spotify. And to your point, it wasn't because of a bad investment. It was because of a mediocre investment, which is different.
Wow,
we had just invested in Last.fm, which was a totally reasonable outcome. But we saw how the sausage gets made in that industry and the power of the labels, and we're like, gosh, this is impossible to make money. And we really loved Daniel, and we saw that the product was phenomenal, and there was some early traction. But we had this bias of, the music industry is so hard, it's never going to happen. And that's why we passed multiple times. And when we wanted to come back, it was too late. And so I think
it was not too late. I'm sorry.
No, exactly.
I love Danny. I love Danny, and I love Daniel. Yeah. And Daniel wanted Danny every freaking round.
Exactly. But, so I think the learning here is when you have, again, it goes back to the founder, when you have, and we knew because, Daniel was working at one of our companies. So we knew the guy was incredible. And so when you have such a unique founder that, again, does have a unique insight about their industry and has the ability to execute on it, and also in this case, you see real signs of execution, don't overthink it. I think that's a problem that we have. And I chat with a lot of VC who say, it's kind of pretty widespread in the industry. Like you think you want to be very smart, you want to be very diligent, and so there is a tendency to overthink. And when something has a fantastic founder and has real movement, then sometimes you just need, even if it's an industry like, oh my God, I've been burnt in the past, I think don't overthink it.
I'm early stage, like seed and A. If I have a world-class founder, I don't give a shit what they're doing.
Yeah.
Like, genuinely do not. There's this like brilliant curve. I don't know if you've seen it, where you start your career and you think it's all about team. You then go 3-5 years in where you're like, oh, I'm smart, I should analyze markets. And then 10 years in, you're like, just team again.
Yeah, I remember, I think Matt Turk shared that meme at some point. And I'm getting there too. I'm back on the other side of the curve.
Okay, you have team, you have traction, you have market. 1 through 3, most important.
I mean, team, and team. I would say that's I'm back to that as the number one. But I would say I probably used to think market, team, and traction. Now I'm kind of probably the other way around. So kind of team, traction, and market.
Given revenue scalings being so unparalleled today for so many companies, does revenue mean less? Does traction mean less? Given 0 to 10 million ARRs kind of commoditized now, as awful and trite as that sounds. Does it mean less?
I don't think it means less. As you know, finding product market fit is the hardest thing in any business, and tons of founders walk around in the desert for years without ever finding it. So I think we shouldn't minimize or trivialize finding real traction and having real revenue traction. I think this is remarkable and it should be celebrated. Obviously, if you are talking about AI, auditing the quality of that revenue is critical. And so that's what people, that's what we spend a lot of our time doing is that revenue long lasting? Is it sticky? And sometimes, obviously, if you have the more cohorts you have, the more you can see the numbers. If you don't have that, then it's going to be talking to customers and also really trying to understand their use case. If it's something that's more like project based and they want to use it once and then they will switch to something else potentially, or is something that, especially if it's inserted inside their workflow, Cursor is a good example. We've made a bunch of those type of investments. Then in all likelihood, even if the number doesn't show it yet, in all likelihood, the stickiness of that product is going to be a lot higher.
Totally agree with you there. Can I ask you, we said about kind of keeping that pure mindset. Partnerships can help in terms of preventing mistakes on, I've done it before and it's lost money, which is a very dangerous heuristic, obviously. When you think about decision-making internally, how does decision-making look on net new deals and how does that differ on size of check?
We have a different size of quorum depending on the size of the check, so who needs to be there. There are always folks from each office, so it's very important, because we work as one team across offices. And then we vote. We vote 1 to 10. You can't vote 5 and 6, so you have to be 4 against. And then it's kind of it's a qualified majority essentially. So if the average is above 6, the deal is approved. And so that mechanism is the same. And then there's also some latitude if you have very high conviction on the deal at the early stage. I think we have a bias for to action. And again, going back to having a beginner's mindset, the person who spends a lot more time with a certain team is obviously better placed to make a judgment call on that team. And so there is there's kind of a collective trust into the partner's judgment.
But if you want to write a $5 million check on the spot, you can do it.
Not exactly on the spot, but you can definitely make the deal happen.
What was the most controversial deal that got through?
I'd say Revolut was pretty controversial actually of all the deals. It's funny. It sounds in retrospect it sounds bizarre, but it may end up being one of the most successful or maybe the most successful, but it was definitely one of the most controversial. The reason for that was that it was quite a few fold. The first one is it was a very European product, and I think the product made a lot of sense for the European audience. It didn't make as much sense in the US context where FX frankly is not a big topic. So I think that was one element where I think US based folks were less familiar with the product and it didn't resonate as well. The other issue we had is it was especially in the early stages, it was a kind of negative gross margin business. I mean, they were basically giving away FX but weren't charging for anything else. You had a little bit of interchange but not that much. And so you had a very low gross margin business, and obviously that wasn't that attractive. And the more they scale, and they scale very fast, all organic and word of mouth, the more they were burning capital. So it wasn't an obvious one. And I think I thought Nick at the time wasn't a natural kind of storyteller and fundraiser. And so I think for all those reasons, it wasn't an obvious deal. Which, by the way, I think that's one of the learning is beware of gross margin in the early days, and I think that's a mistake we made a couple of times. I think Snowflake was a similar story.
What do you mean by that?
Well, it means that you have a lot of businesses that in the early days have really bad gross margin, very low gross margin. So Revolut is an example. Snowflake was an example.
Deliveroo is an example.
Deliveroo was an example. All the LLM providers were very clear examples of that. And I think a lot of the LLM, or a lot of the AI apps have similar characteristics. But I think if that's the only thing that's holding you up, in most cases, I would totally ignore it, because the reality is, when you're getting started, optimizing for high gross margin is the last thing you should be doing. You're entirely focused on growth and building the product. But in most cases, especially in pure software businesses, you will find ways to optimize your gross margins, and the cost, whether it's the underlying cost of the technology you're using is going down. I mean, the AI apps is a good example of that, where the cost of the price per token keeps on going down, or you can just optimize your infrastructure a lot better when you have a lot more volume, and that's what happened with Revolut.
It's so funny how you say statements a year ago and you look back now and you're like, what was I saying? And the speed of the industry transition is so significant when we look at cost of tokens, where it was 18 months ago, it's 99% cheaper. And the fact it was even a conversation.
So if you judge if you made your judgment based on gross margin at that time, on the price of token at the time, you would have missed on, really on great companies and great investments.
And honestly, that was my take on Lovable's gross margin, which is what it is today is not what it will be in the future.
Yeah.
So I totally agree with you there. European stack rank was what I wrote down here, which is if I was in the Europe team, I would honestly be a little bit perturbed by the dual structure of having US people on my decision making, because I'm stack ranked against the growth of Silicon Valley companies. I'm never going to get a deal done. I'm not saying they're worse, but they grow slower. Their execution speeds are often slower. I just think it's if you stack rank them, it makes it harder for European teams to get deals done.
It's not really what we see. We consistently invest about half in Europe and half in the US, and we have one global bar, and I think that's the way we see the world. And we're not fighting for local maximum. We're fighting for a global maximum. We want to be in the very best businesses globally and be the reference investors in those.
Is there a culture challenge in presentation? And what I mean by that is Americans are brilliant at marketing and storytelling. And I mean that nicely, not badly. But respectfully to your fellow countrymen, French people, I'll meet them and I'm they're like, yeah, we're doing 50 million in ARR. And I'm like, wow, that's amazing. Yeah, it's okay. And I'm like, if this was American, it'd be great. Funny. And so my question is there a culture chasm that doesn't carry with European founders to your American partners?
Yes, I think the answer is yes, by and large. So we know, if there's one team that is aware of those differences, I would say it's Index. And so we are very well aware of it, and we take it into account when we vote on deals. And that's also why we leave a lot of latitude, especially when you have data. It's different because obviously data can speak for itself. But I think when at the earlier stage, to your point, the presentation matters a lot more, and that's where leaving more latitude to the partner or the investor who is closer to the founder and spend more time with them, is super important, because we've had that in the past for sure.
Peter Fenton said on the show that price is a mental trap. Interesting statement.
Yeah. How
do you think about your own price sensitivity today?
Yeah, I think is absolutely right. You shouldn't lose a deal on price, especially. I think it's especially true in the early stage, and so we never pass, and we never lose a deal or pass on the deal because of price in the early stage. I think that is absolutely correct. I think it can be a little, where does it stop though? I mean,
is that not a price that's too high? I will ask, are we being paid for the risk that we're taking?
That's not really how we think, to be honest. This kind of risk-reward profile, you don't know, right? Because you don't really have a good sense for the size of the reward. And I think in general, by and large, we've been, the industry has even kind of, underestimated the size of the outcome. I mean, you mentioned the scale of the revenue growth, the scale of the market caps of these businesses. We didn't think that would be the case, even 10 years ago. And so at the early stage, if you had known at the time that the outcomes could be so large, well, then maybe, it was a very fair reward for the risk you were taking. So I think in the early stage, I think he's absolutely right. The only question is, how far does it extend, in valuation? When you're at, you mentioned, OpenAI at 200 billion, like, is the 1 trillion still, a mental trap, or is it, I don't know. So there must be some moment where you get into a slightly different realm, and where, the distribution of outcomes becomes narrower, and the likelihood of, so you have a better understanding of where the company will act. The closer you get to IPO, the closer you should have a sense for what is the valuation, and so you have a better sense for that risk reward profile that you are mentioning. In the early stage, this is so far out, you don't really know. So I think, again, if you go back to the first principle of, if you have this extraordinary founder and there is real traction, then don't overthink it.
Have you done deals though at high prices that in hindsight they were too high price and it negatively impacted the company?
Oh yeah, for sure. Definitely.
And so there is a too high price.
Yeah, there is. There's a price, there is the amount raised, and there is the maturity of the business. Well, we've all seen these companies that raised tons of capital at a very high price before they had proper product market fit, or they thought they had it, but a lot of it was subsidized by investments. And then when they stopped investing because they realized, well, it's not, the customers we're acquiring are not profitable, so we need to stop it. It doesn't really make sense. Then they realized that having all this money and all this team, they had to spend, especially in Europe where it takes a long time, they had to spend a year or two reducing the size of the team, going back to the basics. And so trying to find product market fit after you've grown so much and had so much capital and at such a high valuation makes it really, really tricky.
Do you not find that
is dangerous?
I find that the fault of investors as well. Like, A is so competitive that, someone on our team joked yesterday, said, how soon after doing the seed is it okay to preempt the A? Like, is the next day okay? Because it's so competitive at A. Yeah. I have to stuff you with cash as soon as possible. And like, fuck it, I'll take the risk on you getting PMF, because if you have it, it's too late.
Yeah. We've done it in some occasions. Again, when we found extraordinary founder with either revenue traction or open source traction. We've done that in a couple of open source companies. Then it can totally make sense, and you can really you can get amazing rewards for that.
When you think about ownership, how do you think about ownership internally? Is it kind of the age-old 15%? Has times changed around ownership percentages?
I mean, the time have changed for sure. I started 15 years ago, and we were all aiming for 20% was kind of the minimum bar. This is, we still have some 20% ownership, but it is obviously getting a lot harder. I think if you can get, for us, the goal is to get double-digit ownership at exit. That is that is typically where if we look at the performance of the fund, most of our returns have been generated by companies where we own close to or more than double-digit ownership at exit. And so I think that should be that's what we're trying to aim for.
Do you have more elasticity on ownership because you're able to do multi-stage investing?
Yeah, in the earlier stage, for sure. I mean, I think for us, especially at seed stage, our approach to seed is much more collaborative. The idea is we don't want to compete with people like you and other seed funds and angels. We want to bring them along. We want to work together, and it's conviction investing, and we're gonna pull our weight and be super involved. But this is not the stage where we want to maximize ownership, and so we're not going to have sharp elbows at that stage. Later on, especially at Series A and B's, that's where we really want to because of the time we're going to spend helping these companies and spend time on the board and be hopefully the reference investor. That's where we need a minimum ownership.
I make bombastic statements and then ask for opinions on them. I think Series A is the worst place to be investing today. Obviously, we do Series A. Yeah. So I'm not like promoting ourselves. It's a very truthful exposure. It's like, hey, the price inflection point is so high, often 3 to 5x, and the company progression is often less than 2x. It's a tough space to play. How do you feel about Series A being a bad space to be in right now?
We don't really think about it that way. I think in the early stage, whether, and first of all, the label on stage is, is as good as you want to make it. Is it seed? Is it Series A? Is it pre-seed? I think there is there's a pre-product market fit business, there is a post-product market fit business, and then there is a scaled business. And I think so. You have those kind of three. For me, there are kind of three stages, and we have our funds are seed, venture, and growth that kind of represent those three stages, but they're not really a label. And then for us at the early stage, we don't. The goal for us is to be double-digit owner, reference shareholder as early as possible. And so we don't try to think, okay, is it now a good time? Is it now a bad time? Great companies are created at any time, in the cycle. And so if you can get in early enough and have enough ownership, we don't overthink, is it Series A, is it Series Seed, how much do we own? But again, I think having, being a multi-stage fund helps with that flexibility.
Do you have investments in any of the LLM providers?
We do.
Which one?
We're in Cohere and we have a seed investments in Mistral. Okay,
got it. Do you think about dilution sensitivity down the road? We mentioned delivery. That's kind of V1 of dilution sensitivity, if you want. And LLMs is, I guess, the latest version. Where there's a fundamental question of is it actually a good venture product? Because the dilutive nature of the business is so high.
Well, we'll see at the end of the journey. I think it's the pure venture multiple will likely be lower than some of the other categories in the past. I think that is clear. The difference is that the size of the outcome and the speed, very importantly, the speed at which the size is going to get reached means that you can have, especially if you can deploy a lot of capital, you will still be able to generate a lot of absolute returns. So, I think this, in terms of performance, will still be very high. In terms of pure multiple on early stage investments, it may be slightly lower because of dilution.
Do you worry about the distribution of value in the LLM market when you think about the two teraways obviously being OpenAI and Anthropic, and what we said earlier about the importance of being number one? How much value accrual actually goes to the long tail with other providers? I really question. Do you worry about that?
Yeah, of course I worry about that.
Does Europe need an LLM provider?
Yeah, I think it does.
Can you paint that case for me? I'm not asking as a journalist, I'm asking as a student. Why?
Yeah, well, I think the notion of sovereignty and tech sovereignty is a real notion. I think it's important. You have to recognize that there's a big part of the economy that has to think that way, where you have geopolitical realities that matter. And so if you're a government entity, if you are a quasi-government companies, you may want or even have to use local providers eventually at some point. So I do think there is a large part of the market that needs and want local providers, especially assuming that they are close to the frontier or at the frontier. And so I think there is a real market case for that. There's also a lot of, I think, localization, customization that can and need to happen. And so I think there's going to be a great enterprise market for those providers. So yeah, I think there is a market. Is it going to be smaller than OpenAI? Yes, for sure.
Fair enough. I didn't even disagree with you. Do you think we need government intervention in AI? I spoke to Danny obviously before the show. He said he was the only one to say this actually. He said you should ask him about China. Do you think we need government intervention in AI, pushing you to use one model over another, shutting off access to certain providers?
I do believe that having government entities or quasi-government entities support local innovation is in that critical field is important. I think the way to do it is not necessarily to. I think they should be customers. I think they should buy those products and they should help them as customer rather than as investor necessarily.
Do you think TikTok should be allowed though, for example?
I think it should be allowed, but there should be a bigger conversation about social networks and about the openness of algorithms, which doesn't only apply to TikTok, but applies to X, applies to Facebook. I think those algorithms should be public, should be able to be audited by anyone, but also included kind of independent auditors. I think that's they are not regular companies. I think they are utilities. They are critical infrastructure for the economy and for our political systems. And as such, I think they require a level of a treatment that is different from any random startup.
When we look at the different players today, we're seeing this kind of real concentration of value, almost like never before. You mentioned OpenAI are going to be bigger, but your OpenAIs, your Anthropics, your Cursors, and there's probably 5 to 10 in this kind of ilk. The concentration of value within startups seems to be more prescient or dominant than ever before. Do you worry about this concentration of value and, bluntly, the platform play that comes from that, meaning it is just much more concentrated and makes it more difficult for us investing in smaller players?
I don't think it's that different from before.
Really?
Yeah. If I look at Index, I was looking at the numbers. I think we've invested. So we've been around for 30 years. We've invested, I think, $11.5 billion. We've returned, I think, about close to 30, and we still have 20 plus in holdings. Most of that is basically concentrated in 8-9 companies, and we've invested in probably 300, close to 400 companies over the years. So it's like the power law and the concentration of returns in a small number of names. I mean, we've experienced it ourselves at our level, and so I don't think it's that different than it was before. I mean, I don't see anything that indicates that it's going to be that different, and that's why making sure you are in those category leaders early enough to have big enough ownership, and also earning the reference from the founder, being the reference investor, is the most powerful. It's the only thing that really matters.
What did you miss at the early stage that you were like, oh fuck it, we just have to be in this, and then came in later?
That was just before I started, but we did that with Zendesk, for example, where we passed on the seed and on the A especially. If you look at the memo and the valuation at the time, it's quite funny in retrospect. I don't remember exactly where it was, but very different from where it is today, as you can imagine. And we came in later with our growth fund.
Do you worry for your companies about the concentration of talent? We are in a war for talent today like we've never seen before, and the compensation packages truly are like we've never ever seen before. Yeah. I speak to so many of my companies and like, fuck's sake, Harry, we're competing against Meta and OpenAI. Like, what do you expect? Do you worry about that for your companies?
Yeah, for sure. I mean, you have to worry. I mean, having said that, a big part of the compensation for these early stage companies is around options and is around ESOP. And I think that's where, that's the only way for startups to really compete with these large established players, whether it's OpenAI or whether it's, even Google and Microsoft and the established publicly listed large tech companies. So I think with that, if you can tell a good enough story about this future value creation, there is no amount of package that can compete with that.
Talking of kind of European founders competing, I obviously posted about the importance of working 7 days a week in an increased intensity world where we are competing against China and the US, and that being the new normal. I think very rightly said the same, and then I got all the blowback, and you avoided it all. My question to you is, why do you think that we are in a new world of work intensity and that a new caliber of work is required to build a $10 billion business?
Again, I'm not sure it's changed so much. If you look at the most incredible companies in the past, you look at Revolut, you look at Deliveroo, all of these companies, the amount of work that these founders and these early teams put in was tremendous. I mean, it was 7 days a week. It was nights and weekends. I mean, that's what it was. And so I think that's what it takes. When you're going into those hyper growth mode, and you have and you go for the venture backed route, that is part of the journey. That is kind of in many ways what you're signing for. You need to have two things. One is you need to make a lot of experimentation, there'll be iteration, and so that typically means the longer you work, the more things you can try, and then you need to have a very high kind of growth curve and be able to learn very quickly from those experimentations. But I think the main change to me is how open people are, and I think it's good because then there is no mismatch of expectation. You're not joining a company and realize, shit, they're working so hard that I can't do it, this is not for me. Then at least there's real alignment between what you're saying and what you're doing. And I think that's actually positive.
When you think about the word liquidity, what are your biggest lessons on when's the right time to sell?
You talked about market timing, and we don't try to time the market at entry, and we don't try to time it at exit either. We're not public market investors. We tend to have a very standard liquidity program when a company goes public, where we sell, every quarter over 3 years in a very, recurring, regular, preset way in many ways. We obviously have, we set up exit committee with where you have 4 people on, including the partner who led the deal and another partner who didn't lead the deal and is not as close. So we always have kind of healthy debates, and we can adjust at the margin. But by and large, our view is don't try to be too smart. And then, it's always the same. Then when things go really well and you've sold to early, like, shit, But then you also have the opposite, where if you hadn't done that very systematic approach, you wouldn't have realized a lot of liquidity. So
what did you sell too early and you're most shit about?
I mean, we were a very large investor in Robinhood, and we sold, quite a bit at a lower price than where it is today. We still have a large stake, but there's always going to be counterexamples. And so I think that's the clear one, given I think you talked about their recent price action.
Do you think it is the right strategy to do that, to sell in these quarterly increments when they go public? Given all the information that you have, are you not in a place of asymmetric information where you are better placed? And I actually look at like a Shopify of the world, where you would have lost 98% of the value.
Yeah. Again, there are counterexamples for sure. When we ran the analysis, and we did run the analysis, obviously we didn't come up with it randomly. It came out that
for billions of dollars decision, we did fuck it works.
And obviously, it's hard to do the counterfactual because you can never sell only at the top. I mean, I wish we could, but that's just not going to happen. So. But if we looked at if we had taken different schedules, we would have been worse off. And so we felt that overall, if you look across a basket, a portfolio, and again, it's a portfolio approach, so you may be wrong on one or two, but if you take a portfolio approach and you do it for long enough and consistently enough, then we realized that was the best outcome.
Does the extension of private markets change that perspective? When you look at, say, a Revolut of the world now, I think it's like $75 billion in private markets, whatever it is. But it's just an example.
Yeah.
The extension means that actually secondaries are so much more real. You have the chance to sell much earlier, and actually that public profile is delayed a lot longer. Do you engage in proactive selling in secondary markets?
We may over time in certain situations, like Revolut, we've been in for 10 years, so that you're kind of getting to the end of a fund cycle. So we're not anti-that. I mean,
did you sell secondary in Revolut?
We didn't share that, but we're definitely not opposed to it in general. I think
I wish I could have bought it.
By and large, we tend to hold pretty much everything until IPO.
Do you think that will change?
It may. We don't have any taboo. I think we may have funds that are just at the end of their life cycle, and we want to realize some level of liquidity. I don't think we'll ever sell a lot. And again, it goes back to my first point about the returns being so concentrated in a small number of names. When you're fortunate enough to be a big owner in one of those names, you want to, I think you want to ride it to for as long as you can, and also get the best price discovery is on the public market, and so you want to get access to that price discovery, and so I think by and large we will keep until IPO and after.
When we think about like ownership accumulation across round, the thing that I find hard is Figma is a great example of an incredible business that wasn't maybe obvious for quite a few years, actually. It took a while for Dylan to actually come out with any product.
Yeah.
And it just wasn't up and to the right from day one. Let's put it that way. Okay.
Well, he was nowhere for many years because he was just building the product.
Okay, so there we go. Yeah. But my point being, I do not believe your winners are instantly obvious.
No.
Which means that I think you will often misallocate your reserves and your ownership concentration desires. Do you agree?
Yes, I think it's inevitable. Yes.
So we are not able to accurately predict our winners.
No, definitely not.
So then we should just do the same.
It's funny, like Figma is a great example of that. I mean, I think you picked a really good one. Where Dylan, I always tell his anecdote where he would, we have this CEO retreat every year, and he would come on, and he would keep on coming back, year 1, year 2, year 3, year 4, and he would still not launch. So like, why are we still inviting him? Like, what, And Danny, to his absolute credit, was always so the level of, we always talk about conviction in this business. Danny's level of conviction behind Dylan at Figma is unparalleled. I don't think there are many examples in the business of an investor that has had that level of conviction for so long. We're talking years. It was like, no, I really believe in, I think this founder is really special. I think the product, the fact that actually he's not launching, that he wants to build all those, the right features for the good reasons, not that he doesn't want to launch, that he can't launch, is that he knows that he needs to have that minimum level of feature set to be competitive and for it to work. And then he was always a massive supporter, even in that long period where there was just, not even a product out there.
With respect then, why let Greylock lead the A?
Well, I mean, it's the same with every company. Like you don't invest in every single round on every single one of your companies. So I don't think it's any different. But we invested in, every round.
Is there one way you really backed up the truck where with the benefit of hindsight you go, wow, I got a bit ahead of my skis there?
No, we never felt that way. No. Because as soon as the product was launched, the traction was undeniable. And,
across the whole portfolio?
Oh, you mean, okay, I thought you meant about Figma.
Oh, no, not about Figma. No, fuck no.
Okay, yeah. No, across the portfolio, yeah, of course. Yeah, we've made that mistake before. But again, I think it evens itself out.
What did you not see that you wish you'd seen? You don't need to say the company, but
I think there were times there's, and I think especially in high valuation, kind of frothy time, you have moments where you doubt yourself, where you run your analysis, your own analysis, and you come up with a valuation and the potential for the business, and then someone comes on and says, well, I'm going to pay 2x the price, and I'm going to put 2x the money that we thought we would put. And sometimes, and with a incredibly high level of conviction and speed, and you're like, fuck, like, did I, do they know something I don't? Like, did I miss something? Also, I think there is a tendency where sometimes you talk about, asymmetry of information, but it goes both ways, where sometimes you're so close to a business, you really see how the sausage gets made, and you can end up being more negative or more focused on the negative than on the positive. And so, having external validation of people who are new to the business, just look at the data, look at the team and say it's worth X, and that X is 2X what you think it's worth. So, sometimes you may think, well, maybe I'm being too negative because I see some things, but actually, if I were a new investor, I may be willing to pay 2X the price. And so there are some moments where I say, well, let's do a pro rata, and be part of it, because maybe we're missing something. It's clearly it's a different trajectory, and sometimes that was the wrong call.
Do you do outcome scenario plans? I mean, the biggest mistakes in venture are when we underestimate the size of our winners, which is so common. Do you do outcome scenario plans, and is it worthwhile as an activity?
We don't waste cycles going incredibly detailed into those. We do. I think we focus more on sensitivity analysis. So we focus on what are the few levers that really matter for this business, and where do we think they're gonna go. But it's again, we focus much more on the founder dynamic, the talent that they bring to the team, much more than doing number crunching.
We've mentioned Revolut quite a few times.
Yeah.
I do have to ask about just the story. I don't actually know the story. How did you first meet Nick? Can you just take me to the site? Who introduced you? Where did you meet him? Just tell me the story.
it was a while back. I think it was more than 10. It was 10 years ago now. So I think I saw them pitch at SeedCamp at the one of the demo day. I think that's one interesting thing is typically when you have exceptional companies, one of the indicator is that you will have multiple touch points about that company over a very short amount of time. So I will see them at SeedCamp, but someone will, I will see an ad or I will download the app and someone will mention it to me, a friend, and then another. So in general, you have 3 or 4 touch points, and for me that's a big signal. Well, there is something happening here. If I hear a lot about something in a very short amount of time, like they've caught, they're in the zeitgeist. They've really hit a nerve. I think that's what happened with Revolut, where I saw them at SeedCamp, but somebody else mentioned them to me, and I was using the app, and one of my partners had, So I think it was a multiple. It was multiple signals, but I think the SeedCamp one was the first one.
And so then you ping Nick and ask for a meeting.
Yeah, I think I don't exactly remember how I got introduced. I think I may just have gone to him after the pitch, and also I think we were also we had been introduced through another source. I think one of my partners had also been introduced. Again, I think typically there are multiple touch points when some of these companies. But the reasons why I had a lot of conviction was I came in with a prepared mind. Meaning that I had been looking at the space for a little while. I had looked at a company in the US called Simple. You probably were not born then, but it was the first real neobank.
It's sold to BBVA.
Yeah, exactly. Yeah,
dude,
there you go.
I'm a student of this business. Don't underestimate.
I know. But yeah, so Simple had been around, and again, interestingly, going back to beginner's mindset, a lot of people who had backed Simple were like, well, it doesn't work. Like, it can't work. Look at this. You get bought. At best case scenario, you get bought by an incumbent, and it will never work because people don't. And the main reasons was people don't want to switch bank accounts. It's a pain. Like, why would you switch bank accounts? And it's like, it's gonna be on mobile, but like, well, my bank has a mobile app. Why do I care? And so I had met. I looked at Simple. I had met Monzo as well, actually, and I was looking for a trigger. Like, what would convince people to switch bank accounts, which is such a pain? And what I really love with Revolut was a simple trigger with FX. And like, they didn't sell people, oh, you're going to switch bank accounts. They sold, oh, you're Brit traveling to Portugal for a stag weekend. You're going to get fleeced by your bank. Why don't you get a Revolut card? And I thought that was such a clever insertion point. And then from that point, Nick's view was from the beginning was that he wanted to be the global money app, offer every product. But the insertion point I thought was really effective. And that's how they managed to grow so quickly and organically for the longest time. That because they had this very clear value proposition that was a lot easier than saying, oh, you need to sign up with a new bank, which no one wants to do.
I remember chatting to Antoine Lanel there, and he was like, we won in many respects because we offer snacks to start. So don't try and convince you for the main meal. Just have a little snack, and then you come back for some more and more, and then suddenly you want the main meal.
Yeah,
totally agree with you there. Okay, and so you saw that. Do you think Revolut won in large part because of the lack of banking license that allowed them to move so much quicker?
It's if you ask Nick, I think he will say the opposite, which is if he were to do it again, he would probably go for banking license earlier.
No.
Yeah.
À la poubelle.
Yeah.
No. Seriously?
I think he would. I heard it said that a couple of times because. And you see it today, it's a lot easier to get a banking license before you have scale than after you have scale.
But he would have been prohibited from most of his product expansions.
Yeah, so exactly. I think that we don't know the counterfactual. So it may have been the case. Look, I think the reality. I think they had the right strategy. It's hard to argue with if you look at the outcome and you compare with all of the other players in the space. They clearly had the best strategy based on the outcome, but it is true that it's harder to get a banking license later when you have a very large scale. I think what was really interesting with Revolut though, and which I think is more important than the banking license, is the global approach to the business, and I think again that's something that was very contrarian at the time, and again came from his first principle thinking. The conventional wisdom at the time was banking is highly local, massive regulation. So you have to go very deep in one market. And once you've won that market, then maybe you'll expand to a second market or a third market. But that was the conventional wisdom at the time. And his view was the opposite. It was like, look, banking is a digital service, meaning a single unified platform, and a certain amount of code can deliver the exact same experience across every market in the world. There is no different product that is required in Indonesia versus in Poland or in Estonia, and the same app can do it all. The regulation, the compliance, the front end, which products you can offer to whom, and so all of that varies, but the underlying principles of storing money, lending money, transferring money, all of that, this is just a software and a data play, which is the same. So you can have a single piece of code that works across the globe. So that was his vision. And so from the get-go, he started multi-country as well as multi-product, but he really started multi-country. One of the decisive factors in Revolut's success is the ability to passport across the European Union. And having a license in Lithuania that you can then export and serve the entire of the European Union without having to go market by market. I mean, they had to go market by market eventually to kind of give local IBANs and go deeper, but they could start offering the basic product across Europe with just that one license. And that's what really gave them the scale and the geographical expansion to kind of keep growing and growing faster and compound over time. And I think that's why is it important? I think it shows that when you give European founders one unified market to compete on, they can be as big, if not bigger, than anyone in the world. And I think Revolut is probably one of, if not the best neobank in the market in many ways. It's I think better than anything in the US. For example.
It's the thing I always find quite funny, which is like the US always bluntly laughs at the size of our companies, and I'm like, well, banking, one of the biggest industries in the world, we shit on your neobanks.
Yeah, but I think that's the European Union should look and really study that example. So, okay, what are the ways we could replicate that and really have a unified market? And obviously, we're very involved with EU Inc., which is this initiative to have one kind of single unified status and a super simple way for companies to expand across Europe. And I think that could be an absolute game changer.
Do you think Revolut will win the US? I think the pathway to 500 billion will be largely dictated by US expansion. Do you think they will win the US?
I don't know what winning the US means.
Gain meaningful market penetration in a way that others haven't in the past.
I think they will.
My bet is never bet against Nick.
Exactly.
Nick and Elon are two that I'm just like,
that's the other way to put it.
What do you think makes him so special? I've interviewed him several times, known him for years, not nearly as well as you have done. So I don't mind. Why do you think he is?
It's, I will say it again, it's the first principle thinking. It's the fact that he never takes anything for granted. Like he never listened to conventional wisdom. If you tell him, oh, that's how it's done, he will challenge that. Why? And then he will think about it himself, really break it down into small pieces, solve that problem, and then he will come up with his own answer. He will use experts to kind of inform his thinking, but he will never just take things at face value. And the result of that is that he then comes up with very original ideas and original ways of working. I mean, he does have some inspiration. I mean, Ray Dalio is obviously one, and the way he runs Revolut has a lot of similarity with Bridgewater. But I think that's what's made him so special. And then you add that to an incredible, intensity and ability to maintain that intensity over time, over a very long period of time, in very difficult situations. I think that's what really sets him apart. And then the scale of the ambition. I think that's something that a lot of founders, they want to win something small, and he doesn't. He never. There is nothing that is too big or too complex. Like eventually he thinks, he's convinced there will be one global money app, and that he can be that one global money app that could be better, bigger than when we first met. He wanted to be bigger than JP Morgan. There's still some way to go, for sure. But that's how big he thought from the get-go. It wasn't something that came over time. That was because he thinks about it rationally. It's like, why wouldn't it? There's no reason, there's no law of physics that says that it can't be as big.
Final one before we do a quick fire. When you think about your investor self, what tool in the investor armory do you not have or do you feel weak on that you would like to have or be better on? You can think about it, pausing totally.
Yeah, that's a great question.
I think about it a lot for myself,
yeah,
and for us as a firm. Like, why did we hire JC? Because our customers are founders, and some founders want people who've scaled products to millions of people and thousands in team members. We didn't have that as a fit in the team before, and he brought a very different customer product that we didn't have.
No, I'm a generalist in terms of sector focus, but if you going very deep on a specific sector's nuance, that's not my strengths. And also, I haven't been an operator and a founder, so I won't try to, I will never be on a board meeting and kind of go super deep on your product. I will try to, again, go to the level that is generalizable and help share what I've seen in other places. But, instead of just going super deep and owning that one thing.
When has not being deep hurt you?
I think there are some certain investment decisions that had I known more about a certain industry, I probably, wouldn't have, made the investment.
Listen, I want to do a quick fire round. So I say a short statement, you give me your immediate thoughts. Does that sound okay?
Let's do it.
So what one thing do you believe about venture that other people will think is crazy or strange?
It's not a career. It goes back to one of the early points, which is I don't think people should want to have a career in venture. I think that's the wrong motivation. I don't think it is like an investment bank or like a consulting firm where you join and you can move up the ranks and that's kind of a well-established thing. I think there's a part of
Do you think
passion.
I was wrong then? And I don't mean that badly, but I watched The Social Network when I was 13, saw this intersection of finance and technology that I loved, and thought that is something that I have to be a part of.
No, I think that's exactly the right reason to do it. What I'm saying is not that. What I'm saying is people shouldn't join venture for the status that it brings. I think that's what I mean by that. Like, you didn't do it for the status. You did it because you thought you were extremely excited by the technology, by working with founders, and just to your point, being part of it. And whether which title and which fund and which didn't matter to you. What mattered to you was working with the founders and being part of that movement because you couldn't think of anything else to do in your life. That's the right motivation to do it.
Dude, 11 years ago in Europe, it was not like a status game being in venture.
Exactly. It was the same for me 15 years ago.
I totally agree. Okay, you can choose one partner who is the best picking partner in Index. Who is it?
I'd say Jan is probably the strongest. Yeah, I mean, if you look at his track record, the consistency, and some of the incredible winners that he has, I think he's a great picker.
Which competitor do you most respect?
Sorry?
Which competitor do you most respect, and why them? So, like for me, it would be Point 9 with Christoph. I think the discipline, the focus, how incredibly articulate they are around what is and isn't that type of deal.
Yeah, historically, I've always admired USV. Fred Wilson's blog is the reason why I joined venture. To be honest, I think what he did there in terms of educating people, explaining how venture works, explaining how entrepreneurship works, his level of sophistication in understanding and explaining business models, in picking the right themes early. So I think historically, I would say Fred and USV they were huge inspirations. And when I spent time with them now that I'm in New York, and the way they operate, this very unique way, very collegial, the way that they've decided to stay small against the grain and of the industry, always being against the current. I really admire them. Yeah.
You can invest in one seed fund. Which seed fund do you invest in?
I like Nico at Adjacent a lot. invested personally, and I think he's a very unique investor.
Well, I totally agree. I love Nico. What's the single most memorable first founder meeting and why?
I still remember meeting Hanno at Personio. That first meeting where it was. I think it's actually the case with most investments where it's a yes immediately. Like you meet the person, you hear them talk for 5 minutes, you're like, yeah, that's, we should do the deal. If I had done that with every investment, I would probably, done a lot better than I have, and not overthink it. But yeah, like the clarity of the vision.
Sorry, I'm interrupting you. My biggest fucking lesson is I didn't meet many companies. And so if I had said yes to every company I invested in, I would have made more money. Because I would have done the deal pre-seed, the Vanta pre-seed, and the flexible pre-seed.
Yeah, exactly. I mean, and we had the same, and that we ran the same analysis. Where if you had said yes to every single company that had come to present at the partnership, we'd had done a lot better than we have. Simply because it goes back to the power law. Like you miss one, and we missed a few. Imagine just Spotify. That's it.
Is that the one in the firm that everyone goes, that's the
Of course, yeah.
Listen, dude, it's only 148 billion. So, you missed out on a double-digit ownership. It's fine, dude.
Exactly. Yeah.
But you know what? You would have sold in quarters incrementally. So it's not 148 billion.
Absolutely. Yeah.
What's one book that you really freaking loved? And you just say, everyone should read this.
I finished A Gambling Man about Massa from SoftBank.
Oh, this was, what's his face from the FT?
Yeah, I forgot the name of the writer.
Yeah, Lionel. Yeah, I'm with you. Fuck it.
Barber? No?
Yes, Lionel Barber.
Lionel Barber.
Yeah, well done. Was it good?
It's amazing. It's amazing. It's such a unique. I mean, it's bigger than
He's
bigger
got
than
an
fiction.
underground golf course.
Yeah, like everything is just it's alive that is bigger than fiction. But then what's amazing with him is this ability to, again, talking about ambition, he could have been the king of Japan and just run a very successful company there, but no, he thought global from day one. There was nothing that was too big for him. He went out to raise 10 billion and then on the go he decided to raise 100 billion and become the biggest and most successful. That was the target, to be the biggest and most successful investor in the world. So he had no limits. It took and he keeps on taking, extremely big bets, and he lost it all multiple times, but never stopped and just went back at it. And I think when you read these kind of stories, it shows you that a lot of the limits, they are in your own, like you make your own limits. You could say, if you fail, like, oh my God, I'm bad, it's never going to work. He never thought that way. But okay, let's get back on and move on to the next one. And then let's launch the next business and make it all back. And it came from not much. And it's like just the story is incredible. And I think it's just such a lesson in the power of ambition and hard work and thinking big. I thought it was really inspiring and a fascinating story.
Everyone told me about your marriage and your weddings. Weddings, not to different women, to be clear, to the same woman, but multiple events. To be very clear, that sounds terrible. What's your biggest advice?
Well, it's not terrible. I wouldn't judge, but.
Well, I mean, having several, like a portfolio approach in a short period of time might be challenging.
Yeah.
But what's your biggest advice on marriage and having a great marriage?
When I met my wife, who wasn't my wife at the time, obviously, I was anti-wedding. I wasn't sure I wanted kids. So it took me a long time. We only got married, I think, 11 or 12 years in. So it took me a little while, and we already had kids.
Dude, I could
IPO
married sooner than that.
Yeah, exactly. So it took me a little while, and I absolutely love it and recommend it. I think it brings a level of commitment that is amazing. It kind of grounds you.
A level of commitment that you don't have with not being married.
Yeah, exactly. And obviously, having kids is part of, like really helps with that. And you start thinking as a family instead of as an individual. And I think that is so powerful. It changes your relationship with your parents, with your, you don't see yourself, the spotlight is not on you anymore. You start to think in a longitudinal way. Like you start thinking generation, which is very much more long term, which I think is is incredibly powerful. In terms of getting married, we are very, very different. Very different. We come from very different culture, very different family. I'm an only child. She has 3 brothers and sisters. She comes from Congo originally, so it's very communal. There's always a lot of people. Mine is, very different. And so at first, I was pretty judgmental. And I was like, it's different from what I know, and it's, I have the truth, and that's how things should be. It was so different, and I didn't.
French.
Totally French, and I didn't fully appreciate it. And then now, I've learned to appreciate and value those differences, a lot. I think she's right on most things. And I think we're trying to bring and build a culture in our family that is kind of a mixture of both of our our respective cultures, and so I think that lessons of appreciating people's differences and how they make you better, and they challenge your set minds, I think is great. And that's also what I love with this job, in some ways.
What
when you
did
meet
she
founders,
challenge about you that was maybe uncomfortable for you to appreciate?
The importance of family is a big one. The importance of the beauty of having large family, the beauty of having kids. I was close to my parents, but I never thought of as a in such a communal way.
I worry about kids that I will be less on it and like obsessed about what we do. How did having kids change how you are as an investor?
It is true that it has an impact. I think you shouldn't, we shouldn't lie. I think you're obviously more focused, and again, you're more long-term thinkers in many ways. But it is true that you don't have as much time. So you have to limit what you do and really, really prioritize. It makes you. I think the first thing that's amazing is that it means that whenever you come home, you have this unlimited amount of love and purity, and so it makes you you become a lot more relativist versus what's happening at work. Where you come home and that there is these people who don't care about any investment. Like, it's so, especially when you talk to young kids and you try to explain what you do as a job. Like, my oldest is 8, is going to turn 8 soon, and she still doesn't fully understand what I'm doing. So for 10 years they won't understand. Then you realize, if you can't explain it to your child and they don't fully get it, then it's quite abstract, and it's not really, it's not the true reality. It doesn't really impact people's lives so much on a concrete basis. So it makes you just a lot more. I think it's easier to distance yourself in many ways.
I was talking to a $100 billion founder the other day, and he said, the thing I love about kids is like, in my day job, I'm a $100 billion founder.
Yeah.
When I come home, 1, my baby does not care, and 2, my baby shits on me.
Exactly. So it is very humbling. And then I think you just you don't waste time. You have even, I know you're very good at prioritizing and managing your time, but I think having kids makes you even less tolerant of wasting time, because any moment you spend on the road, at a conference, at an event that you shouldn't be on, it's time you're not spending with the most important people in your life.
Final one for you, dude. It's kind of a horrible one in some ways, because it's just like obvious and shit, but we spoke about kind of people's ambition, Nick's ambition. What's your actual ambition? Like, do you want to run Index when Danny hands over the mantle?
Well, first of all, there is no one running Index, and Danny doesn't have a mentor. It's a purely equal partnership. If you look at, I was looking at the data, so we
is it an equal partnership?
Yeah, it's a very equal partnership, and even in terms of performance. So I mentioned there's like 8 companies that represent the largest share of return. There has been involvement from 7 partners for these 8 companies, and so the performance is totally spread across the partnership, and the responsibilities are totally spread across the partnership as well. We don't have a CEO, we don't have a managing partner, so we do make collegial decisions. So I have no ambition of becoming Index CEO, because there is no Index CEO. For me, there are 2 things.
When you look at the 8 to 9, sorry, you've got Revolut, Figma, Wiz, Scale, any of them?
Yeah, Adyen, Datadog, Roblox. Yeah, I think That's pretty.
It's pretty.
That's very much it, right?
Pretty nuts.
Yeah, there are.
Shit. Well done.
Yeah. I don't know if that's 8, but I think that there should be.
In 30 years' time, I so hope that we can have a portfolio like that.
But yeah, they're all from from 7 different partners and from 5 different locations too. They're not all in the valley like that. And that was always kind of the key focus at Index, as I was saying, is
that is
great
astounding.
entrepreneurs can come from anywhere, and that's there's Amsterdam, there is London,
but the distribution of value across the partnership is really rare. We know the concentration of value. That's nuts.
So that's not my that's definitely not my ambition. I will keep doing this job.
Who did Roblox?
Neil.
Wow.
Yeah. I will keep doing it as long as, and for as long as I can, to be honest, because I love it for two main reasons. One is the people. And again, Index is all about the people, and people is both the founders I work with. It's obviously pretty incredible to see them. Seeing Nick at Seed versus Nick now, or Will at Seed and Will now, it's just, I love seeing them becoming so successful and wealthy and established and transformed as leader. It's just incredible to witness, and I learn so much from them, and I'm so grateful to be part of that. But it's also the people at Index. And the good thing when you've been around for a long time is that pretty much everyone who works at Index have had a part in hiring at some point. So it's only people I really enjoy being with. And it's also just people in the ecosystem. I think what's very special about venture, and that there's a lot of beef on Twitter and so on and so forth. But if you compare with any other industry, it's nothing. And most of our relationships are very cordial and they're very cooperative because we're creating value. There's so much value creation that happens that you don't have to, of course you compete to win a deal, but then you can still go on at the next round, and it's okay. You can still make a really good return, and you will end up working closely with so many different people. And I enjoy most of the people in the industry that I work with. And then the second thing is more philosophical. I'm kind of a techno-humanist in many ways, where I think it's a fact that technology is so critical to alleviate human suffering and pain and disease. And imagine a life without technology, how exposed you are to wild animals, to the elements, to, we forget about that, but our life was shit, we would get sick, we would get eaten alive, and everything that we've done is to extract ourselves and escape that condition. And to me, that's still what we're doing today. We just want, we are building the tools, and in our case as investors, we are helping founders build the tools that will make our lives less painful, longer, happier, more meaningful. And I think and every technology will come with its downsides, but then you have more technology to solve the downsides and then keep that wheel going. And I think that's an incredible human adventure. And I love being, a very small part of it.
Dude, I cannot thank you enough for being a friend for many years. I so appreciate you. I so appreciate Index paving the way for firms, hopefully like mine and like Nico's. And so just so grateful to you. And thank you for doing this, man.
No, thanks. I really appreciate it.